Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures pushing higher this morning as the stock market rebound continues on Wall Street. The prospect of Federal Reserve rate cuts and strong corporate earnings giving investors optimism. That's despite lingering concerns over the impacts of President Trump's trade war. The president suggesting he's going to ramp up India tariffs substantially in the next 24 hours. He says pharma and chip tariffs are coming soon, too. That's according to an interview he just did with CNBC. Plus, Palantir shares jumping today after the data software company reported a 48% increase in quarterly revenue. CEO Alex Karp citing the astonishing impact of artificial intelligence. The company posting quarterly revenue of $1 billion for the first time. It's also raising its full-year guidance. And the next test for the AI rally comes tonight with AMD results. The chip company set to provide investors with an update on demand for its artificial intelligence hardware and the impact of tariffs. The company also set to benefit from the Trump administration's reprieve on sales restrictions to China. Let's get a check in on stock futures right now. We're seeing a mixed picture actually for the moment. So not sort of a unanimous wholesale extension of the rally and the rebound that we saw yesterday. But right now, the Nasdaq is indicating a gain of about 1/3 of 1%. The S&P pointing to a gain of a little less than 1/5% at the open. The Dow very slightly lower. Of course, a lot of earnings news and headlines that investors are following going to push around individual stocks a lot more than the averages. Let's dig into our top stories of the day now. The AI trade is heating up after Palantir tops $1 billion in revenue for the first time. Plus, second quarter earnings rolling in with more than 100 S&P 500 companies reporting this week. And the debate over rate cuts is on after the weaker than expected July jobs report. Joining me now, senior reporters Brooke DePalma and Josh Schaefer. Josh, let's start with Palantir here. Not just its own blowout numbers, but sort of what it signals about this continuation of the AI trade.
Yeah, Julie, so Palantir coming out topping $1 billion in revenue for the first time, as you just mentioned. And what was interesting within that release, too, is we talk a lot when we talk about Palantir of course, their government contracts, right, and what they're doing in AI in that space. But inside the release, you also saw their U.S. commercial unit growing 93% year over year. So you're seeing sort of a broadening of their revenue streams. And so analysts on the street arguing that that is a sign of the broadening of AI spending, right? It's not just government spending that's fueling Palantir. And of course, the other thing with Palantir that always comes up, that stock's up about 7%, as you're seeing on your screen now. It was a $25 stock a year ago. It's now trading hands at $171 a share. The thing has ripped over 500%. Everyone always talks about valuations when it comes to Palantir. Valuations are very high. Well, that's what people have been arguing about this whole AI trade in general, right? Has been sort of this, well, valuations are extended. Can they really keep extending higher? Can they really keep extended higher? Palantir has been the extreme part of that case, but it's really been where you've seen this bid in the market over the last 3 months now, over the last 6 months, over the last 2 years at this point. That has been where investors are piling into right now. I'm taking a look just at our Wi-Fi Interactive and where the trade has been as we rallied back over the last day. Look at what led the NASDAQ 100 yesterday. You have NVIDIA up over 3%, Alphabet up over 3%, Meta, Broadcom, Palantir closed 4% higher leading into earnings. So that AI trade has really just been where investors have been looking to pile into right now. And Palantir, it seems, giving no real reason for that to stop with that release.
Yeah, and I'm going to exaggerate a little bit here, but sometimes it does feel like it's AI and then it's everything else, right? And everything else is sort of subject to the forces that typically shape earnings and shape investor perception about earnings. So today you have Palantir, and then you have something like a Caterpillar, Brooke, that is talking about tariff effect on its business.
Yeah, AI and everything else here. When you think about Caterpillar, of course, that yellow and black, iconic, behind the bulldozers, behind construction, you see that stock under pressure in early hours, extended hours here this morning. And what we heard in the presentation that Caterpillar put on their investor website is that tariffs are expected to net incremental tariffs of around $1.3 billion to $1.5 billion. That's expected to hit the company this year. They said that that includes as much as $500 $100 million this upcoming quarter alone. And this is a stock that has been under pressure as we continue to make way into the year, as we try to understand what exactly these tariffs mean for these manufacturing companies. The company also did say that those tariffs, they drove up manufacturing costs for the company. That hit profit, even as sales volumes remained steady. And so it's clearly we're seeing some of the tariff impact show up for these companies. And now keep in mind, after that extended deadline, the CEO saying on the call this morning that this is expected to now hit the company come August 7th once that deadline shows up.
And then, Brooke, also on the earnings front, I know you're watching everything consumer, as you do. What are we hearing on that front in terms of earnings this morning?
Yeah, international, the consumer does well, but here in the U.S., we're seeing a softening, and that was reiterated this morning with both Yum Brands as well as Marriott. This international growth offsetting a slowdown here in the U.S. And taking a closer look at the U.S. same-store sales growth for Yum Brands, what we saw was an ongoing continuation of Taco Bell really outperforming its peers, KFC and Pizza Hut. What we saw there was Taco Bell was the only segment of the Yum Brands business that saw same-store sales up. And then we saw a decline of 5% from both Pizza Hut as well as KFC here in the U.S., especially as they really try to drum up excitement. We know that KFC is falling behind the competition when it comes to the chicken business, when it comes to, up-and-coming competitors as well, like Dave's Hot Chicken, among others. And what we saw from Marriott International is that they actually cut their full-year forecast for revenue growth and profit. They cited a slowdown in demand for travel here in the U.S., but once again, international, they did say that offset some of the slowdown that we're seeing here.
So on a macro basis, investors are sort of disregarding those kinds of less positive numbers, right, Josh? And part of that seems to do with the AI trade. Part of it has to do with now the changing outlook for rate cuts as well.
Yeah, Julie, so you've moved to the market now pricing a 90% chance that the Federal Reserve cuts interest rates in September. That is up significantly over the past month. And what's been interesting with that move is you kind of have clear debate now among not only market participants, but also sell-side economists. So when you're looking all the way out to the end of the year, there's a 50% chance the Fed cuts rates by 75 basis points, 3 interest rate cuts, or a 50% chance that they cut by 2. So you're seeing debate there. You look at what sell-side economists are saying. The team at Goldman argues the Fed will cut 3 times. The team at Bank of America still doesn't see the Fed cutting at all. The economists over at B of A would argue that the impact of tariffs on inflation will keep the Fed from moving. But essentially what that all tells me, we need some more data for the economic narrative to really take hold here and be the key driver, right? We had a jobs report on Friday that, yes, was weaker than thought, and it showed that payrolls were weaker than previously thought for the prior 2 months. But overall, it doesn't give you enough to really have a clear basis. So the team over at BlackRock looked at those 2 things in terms of, okay, AI earnings were great last week, and the economy seems to be weaker. Which one am I going to own right now? They're going to own AI stocks until they're really more concerned about the economy and have more data to fully understand that story.
Of course, stocks were rallying even before we thought cuts were coming. Now cuts are the reason that stocks are rallying. Go figure. We know how all this works. Brooke, Josh, thanks a lot. Appreciate it. Well, Pfizer shares getting a boost in pre-market trading after topping Wall Street estimates in its second quarter results. It also raised its forecast. Here with the key takeaways, Yahoo Finance senior health reporter Anjali Khemlani. Hi, Anjali.
Hey, Julie, that's right. Pfizer did give us a bit of a raise on its margin. We did see that pump for the earnings per share for 2025, 10 cents. And it could have been more, but they had a 20-cent hit from a recent licensing deal with a Chinese biotech company. So that's why it wasn't a little bit larger, but reaffirming revenue for the year. And that's sort of where looking at what the second half of the year is going to entail is going to look like. Though the interesting part is the beat that you just saw on your screen, that $14.7 billion coming in ahead of Wall Street's estimates. Now looking at this reaffirming of the 61 to 64 billion, that's really interesting to the street because we do know that COVID products are still a little bit part of what they're looking at for the year. We haven't heard what the numbers or expectations are. Of course, that that call coming in a little bit later today. We're going to hear from CEO Albert Bourla as well. So we'll be tracking that. But right now, it looks like the strategy of cost cutting, the goal to achieve $4.5 billion in savings through the end of this year, and then a little bit more through 2027. That's in play and lended a hand in the beat this quarter, as well as looking at PadSev, that acquisition from CGen, giving a product to the pipeline and to revenues that they're looking to, sort of fill more in. We know that they're facing those patent cliffs by the end of the decade. And so products like this are proving out that strategy, at least for this quarter. So we'll have to stay posted.
Yes, as we know, a lot of macro policy issues looming over the pharmaceutical industry writ large, not just Pfizer. Anjali, thank you. And stay tuned. We've got more on Pfizer's earnings coming up. Anj and I were going to speak with the Pfizer CEO, Albert Bourla. That's coming up at 3:30 p.m. Eastern. You don't want to miss that. Coming up next, we'll sit down with Mohamed El-Erian to talk the Fed, data, earnings, and more. Don't go anywhere. You're watching Morning Brief on Yahoo Finance. Time for some of today's trending tickers. We are watching Vertex, Kyndryl, and Caterpillar. First up, Vertex Pharmaceuticals announced it will not advance the new pain treatment into the next phase of testing. That's sending the shares lower and overshadowing stronger than expected second quarter results. The company swung to a profit of just over $1 billion during the 3-month period, having reported a nearly $3.6 billion loss the year prior. Vertex has been diversifying into non-opioid painkillers to reduce its dependence on cystic fibrosis medication. That's a field that it currently dominates. Next, Kyndryl, the company which provides IT infrastructure services, saw consulting revenue rise 30% from a year ago. Kyndryl CEO saying that businesses are still spending on tech to boost productivity and to take advantage of opportunities like AI. Revenue tied to its work with cloud hyperscalers saw an 86% year-over-year increase. Kyndryl's partners include Microsoft and Alphabet's Google. And finally, sluggish construction equipment demand and tariffs weighing on Caterpillar as it reports profits below Wall Street's estimates. The company is saying it expects to take a $1.5 billion hit from tariff-related costs in the full year, with costs in the current quarter coming to as much as $500 million. Revenue also falling by 1% in the quarter due to weakening pricing power. Meanwhile, sales were higher in Caterpillar's energy division, and it raised its revenue outlook, expecting slightly higher sales for 2025 than 2024. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, in a wide-ranging interview with CNBC Tuesday morning, President Trump reiterated his criticism of the Bureau of Labor Statistics, said he was close to picking a new Fed chair, and teased new tariffs on semiconductors. Joining me now, Mohamed El-Erian, president of Queen's College, Cambridge, to talk about that and many other things. Mohamed, good to see you.
Good morning, Julie.
I would like to start with this whole situation over the Bureau of Labor Statistics, the BLS. With President Trump's removal of the person who heads up that agency, what does that do to confidence in future statistics? We've got, for example, CPI coming next week from that agency.
So I think there are 3 takeaways, Julie. The first one is that the way the head was fired, and she was fired just following data releases that the president didn't like, that erodes institutional integrity. And institutional integrity is very important in the US economy. The second focus is on the problems we're having collecting and estimating data. These have been long-standing problems that have been getting worse. As you know, the reporting level has come down. As you know, the methodology used for estimating when you don't have the data is breaking down. So there are fundamental issues that have to be addressed. And that includes not incorporating enough new data sources, because we saw during the pandemic that there are all sorts of non-conventional data sources that shed a lot of light. But the third issue, the one that's not talked enough about, is when you tend to have such large revisions, they tend to be at point of economic inflection. They tend to be when things are changing in the underlying economy and the data simply cannot keep up with what's changing. And I think that third element is going to be important as we go forward.
Okay, so let's dig into that third element, because those revisions were alarming, right? And on Friday, it seemed to sort of fundamentally shake the assumptions that a lot of market participants had about the labor market, that it was holding up okay. So A, do we believe those revisions? Do they reflect what's going on? And how concerned are you then about the labor market?
So I think the revisions are consistent with a lot of anecdotal data that comes from talking to households, that comes from looking at companies' earnings. And what you basically get is the following. Pricing power for those who sell to low household incomes is very low because low income households are suffering. We also have seen other signs of weakness. So I think what the labor revisions have picked up is a weakening economy, not an economy going into recession, but a weakening economy. And ironically, 2 days later, in terms of trading sessions, the bond market has priced in a weaker economy. The pricing of Fed cuts, that probability, as we heard, is up to 90%. So the fixed income side of the markets has understood what the data is telling us. The equity side is being supported in a fundamental way by two things. One is the notion of FOMO. Every time we've bought a dip recently, in the recent few years, it has been profitable. So people have been conditioned to buy a dip. And second, this distinction between tech and AI and the rest. And tech and AI is enough of a locomotive to drive the whole market up.
I want to talk more about that in a moment, but first I want to dig a little bit more into the labor market figures, because we've talked to some folks who have suggested that if the Fed had had those numbers, they would have cut at the last meeting. Do you think that a cut in September is a lock, and do you think it could even be an outsized cut?
So first, I agree that had they had those figures, they would have cut, and a number of us were urging them to cut based on what we were witnessing from the bottom-up data. But they are very top-down driven. So the top-down data didn't show them that until now. So yes, they would have cut and they should have cut. Secondly, is it a lock for September? Yes. Is it possible that they do 50 basis points and not just 25? Yes. I mean, remember a year ago, they didn't do anything in July. And then come September, they delivered a jumbo cut of 50 basis points. So I think a 25 basis points cut is a lock. A 50 basis point cut is a possibility, not yet a probability, it's a possibility.
And let's talk a little bit more about the structure of the Fed. You made some waves recently, Mohamed, when you suggested that Jay Powell should just step down now, shouldn't wait till his term is up. And listen, I heard from a lot of folks who did not agree with that assessment. Do you still hold that view? And why do you think that's the right thing?
I do, and like you, I had lots of discussions, and about half of the people I spoke to vehemently disagree, and the other half agree, but don't want to be public about it, because they're worried that this will be interpreted as somehow undermining the Fed. The reason why I said what I said is because I want to protect the integrity of the Fed. Chair Powell is leaving in May for sure. Everybody knows that. He's going to be a lame duck well before this, because we're going to have an announcement about who's going to replace him. The longer he stays there, the more the administration is going to look for cause to dismiss him. The more they look for cause, the more they're going to go into the Fed, and we risk a non-recoverable mistake, which is undermining the integrity of the Fed for a long time. And it's not just the administration. You've seen the Speaker of the House and Congress thinking maybe we should revisit the act. So these attacks are broadening and deepening. Now, is it the first best for him to step down? No, it's not. But the first best is not available. The first best is that he serves out his term and the Fed doesn't get attacked politically. But I suspect we all know that the Fed is going to continue to be attacked as long as he's chair.
Yeah, I think that is likely a safe assumption. I'm not going to continue the should Powell stay or not debate. I want to move on to something that we heard from the president this morning. He was asked about the four contenders that have been talked about to replace Jay Powell at the Fed: Kevin Hassett, Kevin Warsh, Christopher Waller, and Treasury Secretary Scott Bessent. And he sort of dismissed Bessent. He said, no, he doesn't want the job. He's off the list. We're not going to do that. He didn't really address Waller. He said the Kevins would each be a good choice. Do you think a replacement for Powell like Waller, because he is already a Fed insider, would be more helpful to the cause of Fed independence?
I think either Kevin Warsh or Chris Waller would be helpful to Fed independence. They are both experienced. One is serving on the Fed board, the other one served on the Fed board. They're highly respected. So I think, yes, they would be good for Fed independence. What I found interesting is that while he said that the Treasury Secretary is not interested, he said there were 4 other than
He
Scott
did.
Bessent.
Who's the other one?
I suspect it's David Malpass. That's the name that has been mentioned the most. David was the president of the World Bank, and before that, he worked at Treasury.
Do you think he would be a good choice?
So I think you have very strong candidates in Kevin Walsh and Chris Waller.
Okay, that's a diplomatic way of saying it. Mohamed, I want to move back to this AI theme, as I promised we would come back to that. I know that you tweeted also about that this morning, the sort of Caterpillar versus Palantir economy, so to speak. What does that tell us about the economy that that you have this divergence? Is it concerning, in other words, that a lot of the growth engine right now is coming from things related to AI?
No, that's what I would expect would happen. I am incredibly optimistic about the productivity enhancing potential of AI and more generally of innovation in technology, in life sciences, and in robotics. And I tell you, I've never been as optimistic about productivity as I am right now. But it is a sequence. It starts with firms that are either quasi or completely AI native. And what Palantir told you today is that they are monetizing the AI. So those who doubted it could ever be monetized, well, it's being monetized. And we're seeing this not just in Palantir, but in other places. The second challenge that comes after you monetize with the AI natives and quasi-native is diffusion throughout the economy. And that's when you get the huge productivity impact. And what we are learning is that this diffusion process is uneven, that some firms are quick adopters, others are very slow in adopting. So dispersion is not going to just be between tech and non-tech, which is what we're seeing today, but also within non-tech between those that are quick to understand the incredible potential of AI and those who don't have the initial conditions to do this quickly.
And then when you look at Caterpillar, on the other hand, its business is still sort of plugging along. It did talk about a tariff impact. And I'm curious your current thinking on tariffs. We did have the president also in that conversation saying the tariff on India is going to go up in the next 24 hours. He's sort of trying to punish them for buying Russian oil. He said they're getting close on China. So what does all of this mean for economic growth?
So first on Caterpillar, it's interesting because a few months ago, they simply couldn't tell us what the impact would be. Now they're telling us the impact is about 1.3 to 1.5 billion of additional cost. So that is telling you that they are incurring the cost and they're not able to pass on as much as they would need to keep their profit margin constant. And I suspect that we'll hear this over and over again from most companies, not all, then from most companies. India is really important, Julie, because that's a secondary sanction. The president is threatening tariffs on India because India buys oil from Russia. And secondary tariffs, once you go down that road, the question is going to be, what about China? China also buys a lot of oil from Russia. And we are in the midst of negotiations with China. Will this play in? Will this not play in? Will it be inconsistent with India? These are all questions that are going to have to be sorted out in the next 3 months.
Mohamed, it is always great to get some time with you. Got to leave it there for today, but hope to see you again soon. Thank you.
Thank you.
That does it for Morning Brief. Coming up on Yahoo Finance, opening bid. Our executive editor, Brian Sazzi's got much more ahead on Yahoo Finance. Keep it here.